Your British pound trade just hit its stop loss after moving in your favor for 2 hours. The familiar surge of frustration floods your system. Your next euro-dollar setup looks mediocre. Yet you enter anyway because you need to make back what you just lost. That trade also fails, doubling your losses and triggering anger that clouds your judgment for the rest of the session. By market close, you've violated every risk management rule you've ever learned, turned a small planned loss into a significant unplanned disaster, and you're already dreading tomorrow's trading session. This emotional whiplash between hope and despair, confidence and doubt, excitement and fear isn't just unpleasant, it's systematically destroying your ability to think clearly when clear thinking matters most. The emotional roller coaster doesn't just feel bad. It rewires your brain in ways that make profitable trading neurologically impossible. What I'm about to reveal are 3 specific mechanisms that trap traders in emotional cycles, and the precise mental techniques that allow you to step off the ride permanently. Emotional contagion loops. Your brain automatically mirrors the emotional volatility of whatever you're observing, and price charts create artificial emotional experiences that have nothing to do with your actual life circumstances. When you watch your position move against you, your nervous system responds as if you're personally under attack. When you see green candles, your brain releases chemicals associated with personal achievement. This emotional contagion turns chart watching into a mood drug that hijacks your natural emotional regulation. The contagion mechanism works through mirror neurons that fire both when you experience something directly and when you observe it happening to something else. Your brain can't distinguish between watching a horror movie and being in actual danger, which is why movies create real emotional responses. Similarly, your brain can't distinguish between watching your position lose money and experiencing actual financial threat, creating genuine stress responses to imaginary dangers. Price movement becomes emotionally addictive because it provides constant stimulation that feels more intense than normal daily activities. Your brain starts craving the emotional highs and lows of trading because regular life feels boring by comparison. This addiction to emotional intensity makes it almost impossible to trade systematically because systematic trading feels emotionally flat compared to the drama of reactive trading. Breaking emotional contagion requires understanding that your feelings about price movement are completely artificial. The red and green candles aren't actually events happening to you, they're just visual representations of other people's buying and selling decisions. When you can observe price action without absorbing its emotional content, you stop being controlled by market mood swings and start responding based on your predetermined analysis. Professional traders develop what researchers call emotional firewall, the ability to process market information without adopting market emotions. They see price movement as data rather than drama, allowing them to maintain stable emotional states regardless of what their positions are doing moment to moment. This emotional independence is what allows systematic execution under any market conditions. Understanding emotional contagion prepares you for the second mechanism that amplifies trading stress: prediction anxiety cycles. Your brain experiences genuine physical stress when it has to make decisions about uncertain outcomes, and trading forces you into constant prediction anxiety that accumulates throughout your trading sessions. Every entry decision triggers your nervous system because you're committing resources to an unknowable future outcome. This prediction stress compounds with each additional decision until your cognitive capacity becomes severely impaired. The anxiety cycle works because your brain interprets unknown outcomes as potential threats requiring vigilant monitoring. When you enter a trade, your subconscious assigns monitoring resources to track that position, even when you're not actively watching it. Multiple open positions create multiple anxiety streams that compete for your mental bandwidth, eventually overwhelming your capacity for clear thinking. Prediction anxiety also triggers perfectionist behaviors that make trading decisions increasingly difficult over time. Your brain starts demanding more analysis, additional confirmation, and extra preparation before each trade, because making uncertain decisions feels psychologically dangerous. This perfectionism creates analysis paralysis that prevents you from taking good setups, while simultaneously making you more anxious about the setups you do take. The compound effect shows up as decision fatigue that gets worse throughout your trading day. Your first few decisions feel manageable, but by afternoon your brain is exhausted from constantly evaluating uncertain outcomes. This fatigue makes you more likely to make impulsive decisions or avoid decisions entirely, both of which destroy systematic execution. Professional anxiety management involves accepting uncertainty as normal business conditions rather than threats requiring resolution. Instead of trying to predict outcomes accurately, professional traders focus on managing probability distributions and position sizing that allows them to be wrong frequently without emotional distress. This shifts their mental energy from outcome prediction to process execution, eliminating most trading-related anxiety. But even managing prediction anxiety isn't enough when you're trapped in the third emotional mechanism, identity fusion syndrome. Your sense of self becomes entangled with your trading results when you spend hours daily focused on market performance, creating psychological fusion where account fluctuations feel like personal fluctuations. Instead of trading being something you do, it becomes something you are, making every loss feel like personal failure and every win feel like personal validation. This identity fusion creates emotional volatility that mirrors your account volatility. The fusion mechanism develops gradually as trading becomes your primary source of daily stimulation, challenge, and feedback. When your brain doesn't have other compelling activities to generate meaning and accomplishment, trading fills that psychological void by becoming your primary identity anchor. Your self-worth gets calculated through your trading performance, rather than through broader life achievements. Identity fusion explains why many traders feel empty and directionless when they're not actively trading. Their sense of purpose becomes tied to market participation, rather than to personal development, relationships, or other meaningful activities. This creates psychological dependence on trading activity that makes it impossible to be selective about trade quality, because inactivity feels like personal stagnation. The fusion also creates outcome dependency, where you need your trades to work out in order to feel good about yourself. This emotional attachment to results makes it psychologically impossible to cut losses quickly or hold winners patiently because your self-image becomes hostage to position performance. You start managing your identity rather than managing risk. Breaking identity fusion requires deliberately cultivating sources of meaning, achievement, and stimulation outside of trading. This might involve physical training, creative projects, social activities, or professional development that provides psychological satisfaction independent of trading results. When your identity is anchored in multiple domains, trading becomes just one activity among many rather than the central organizing principle of your life. Professional identity separation involves treating trading as a skill-based business activity rather than as a reflection of personal worth or intelligence. Successful traders often have intense interests and commitments outside of markets that provide emotional stability and perspective that supports better trading decisions. They trade for business reasons rather than for psychological reasons, which allows systematic execution without emotional interference. The ultimate realization involves understanding that emotional roller coasters in trading are symptoms of psychological dependencies that make profitable trading impossible. When you need trading to provide excitement, validation, or identity, you can't make the boring, systematic decisions that actually generate consistent profits. Breaking these dependencies doesn't make trading less rewarding. It makes trading more profitable while making your life more emotionally stable. Comment below and tell me which emotional trap you recognize most in your trading: contagion loops, prediction anxiety, or identity fusion. Because getting off the emotional roller coaster means identifying the specific psychological mechanisms that create emotional volatility in the first place. Master the ability to observe markets without absorbing their emotions, make decisions without prediction anxiety, and maintain identity independent of trading results. And you'll discover that emotional stability is the foundation that makes all other trading skills possible.